Welcome to our training where we're going to be talking about private money financing today, especially for the purchase and acquisition of real estate. We're going to talk about how to use private money to buy residential properties, buy commercial properties. We're even going to talk about how you can use this kind of financing to refinance these kind of properties. You can actually buy groups of different properties, get money for fix and flip, buy and hold. We're going to dive into it all. So by the end of this training, you're going to know how you can rely on hard money lenders, private money lenders to help you get into the real estate game, especially with COVID-19 and everything that's happened. In real estate is going to be a phenomenal opportunity to be able to buy if you know where to get the money. But the big banks are not the best place. Today, we're going to talk about how to use private investor money to be able to tap in to get the money you need to invest into real estate. So let's talk a little bit more. When we talk about private money financing, first of all, there's a lot of different variations of this. Okay, we have done and will do other training on using private investors to actually invest in your business, such as equity financing. And this is where you give up a portion of equity in your business to actually get the money you want from private individuals. But for today's conversation, we're going to be talking about using this primarily for real estate, where you actually are looking for the bigger loans for hundreds of thousands or millions of dollars or tens of millions of dollars to buy or deal with residential or commercial real estate. Okay, now not every entrepreneur is going to qualify. We're going to talk about qualifications today, and we're going to talk about how it's going to be easier to get money with these private investors than it is to get money through the big conventional banks. So what are private lenders? Well, ultimately, these are individuals. They're investors, very different than banks, right? Banks are institutions, and they're usually governed by all kinds of rules and requirements. But there's a lot of people that want to get in and lend money personally to get a rate of return. So private lenders are in the business of taking funds from private investors, and then what they do is they make private business purpose loans with those funds. So ultimately, they might want to lend their own money. They may actually want to come in, and Jennifer, thanks for tuning in from YouTube. They might want to actually come in and lend their own money. Sometimes that's the case. Sometimes it's the case where they raise money and pull money together in funds from other investors. Then they use that money to come in and invest. So I was actually in a very interesting conversation last night, was in Sarasota at a mastermind just on this topic. Okay, one of my buddies is a very big in the private investment space for real estate. So he owns apartment complexes. He has over 2,000 units. And the conversation at the table was he was talking to somebody else who's going to probably become a potential investor in that deal. And they were talking about tax benefits. And it was kind of crazy, the fact that you could put your money into these kind of things and get all kinds of tax credits and other benefits. So that's an example of somebody that's lending his own, or that's coming in and using his own money to invest in real estate. But then that's not enough to buy all the units he wants to buy. So he's recruiting other people to get an 8, 9, 10% return on their money by jumping in and putting their money in his pool. And there's all kinds of additional benefits like tax credits, as I mentioned, beyond being able to get a rate of return on their money. So investors expect a decent return from these investments, and interest rates for money borrowed from banks is significantly higher. So when we talk about private investors, oftentimes 8% sounds like a good round number. And by that, I mean, I talk to a lot of people that are in the residential and commercial real estate investment game, and a lot of them give the investors that are coming in 8% or 8% returns on what they get. I'm not saying that's the standard, but I talk to enough people that 8% is a pretty round number of what kind of return people get from investing into commercial and residential real estate into some of these deals. As I mentioned, there's also tax credits involved. There's a lot of other benefits as well. In this case, they can even get ownership interest in the actual properties if they're putting in certain amounts of money. So all these investors have different perks and different kind of returns that you're able to get. And again, banks are a little bit different because you're not going to typically get that kind of return if you're putting money into a bank, right? And we talked about that as well at the table, what you get return-wise from having the money in a bank account, what you get return-wise of putting that money into real estate. So these factors raise the private lender's expenses. Those expenses are then passed on to the ultimate borrower, unlike with angel investing or venture capital. So ultimately, when it comes to rates and when it comes to fees, things like this that the actual lender's charging or the banks are charging, oftentimes that actually comes down and it basically kind of goes down to the borrower, ends up paying those fees. So in this case, you could bypass a lot of those fees. And we will talk about some specific fees that are involved with private investor money just by working with a private investor versus working with banks that attach all these abundance of fees. So apart from possibly most qualifying for traditional lending, there's a lot of other reasons that people would want to do this. Look, qualifications, one, it's way higher to qualify for financing from a commercial bank than it is to qualify through a private investor. And that's because big banks are basically lending money that's guaranteed by SBA. So you have two qualifications. You have to qualify with the bank's underwriting guidelines. You have to qualify for SBA's underwriting guidelines. And SBA requires good credit, cash flow, collateral. It's very difficult to get real estate financing from big banks because they are backed by SBA. So qualifying is definitely one reason, right? Because these private lenders, it's way easier to qualify because we only have to meet their requirements, not a bank's requirements and not SBA requirements. But banks are also tougher to deal with than a lot of private investors. They're subject to significant state and federal regulations as well. They've got to work with governmental and quasi-governmental agency programs like Fannie Mae, like Freddie Mac, like those that come from SBA, as I mentioned. And these regulations often dictate which businesses a bank can lend to and what borrower profiles they can look at. So look, it's really easy to have a banks are bad conversation. And I'm one of the first ones that talks about all the problems that I don't like about being able to get money from a bank and why they make it difficult. And Jennifer, thanks for coming in from Panama City. So, but that being said, the reality is banks are government insured. And we are safe keeping our money there because the government insures that bank. But in order to get insured by the bank, you have to meet a lot of different requirements. And that is the problem, is that there's so many requirements these banks must meet that even though it's easy to kind of paint them like the bad guy, the reality is they're following guidelines that are passed down to them from the places that are actually insuring the money or basically governing the underwriting of these loans, like Fannie Mae, like Freddie Mac, like VA, like HUD, for example. So private lenders, while still subject to state and federal laws, are significantly less regulated. Okay, they can be more flexible with the loans and who their customers are. It's one of the reasons we use them. Okay, getting money from any individuals is easier than getting money from any institution in almost any case that I've ever seen. Meaning, if I can get a bank loan or a private investor loan, I always go private. It's easier. If I can go get money from a peer-to-peer lending platform where they're pulling together private individuals' money versus banks, it's always easier. And almost any example I can give you where individuals are the ones lending the money, not institutions, it's almost always easier. And the reason is common sense. Okay, my dad was a banker, an accountant, did a lot in the industry. And he'd tell me stories I remember growing up about, people in my farm community where I grew up and how he would just do these handshake deals with them. He could do that in a small community bank. That still exists today. It's the reason that PPP loans were easier to get from community banks, because community banks are less regulated and they can kind of think on the fly and make more decisions on the fly and be more flexible on their standards. Big banks like Bank of America, for example, they lend to tens of thousands of borrowers. So as a result, they have to put guidelines in place that can cover everybody, that can govern every single different one of their branches in every single state. That's not easy to do. So in order to do that, they have to come up with very conservative guidelines to give their banks to make sure that they're protected. That's the only way they can lend to the masses. Private investors, though, are kind of like my dad was back in the day when he used to lend money on a handshake deal. They can make common sense decisions based on information that banks can't make that decision on. They don't have that flexibility. So the bottom line is, when big banks aren't your source, private investors are a better source because they're more flexible. They can make on the more fly decisions. You're not confined to these guidelines that the big banks have. So hence, it's generally a lot easier to get money from private investors versus traditional banks, because private investors can customize each loan based on your need. They can customize their decisions based on every individual they have. They're not trying to fit everybody into a box like you are with the big conventional banks. So in contrast, we talked about the banks, they don't have that much discretion because they're federally insured, because they're trying to come up with guidelines that regulate everybody. Guidelines are more rigid and it's way harder to get approved. So banks tend to look at financial histories and credit through easily traceable and documented income sources. This makes it very difficult for self-employed borrowers. It makes it very difficult if you have tax returns that don't show a profit. Look, let's be honest. Being business owners as we are, we write off as much as we can and we pay as little taxes as we possibly can. That's what we do, right? Then we have the money that we keep more of and we reinvest into the growth of our business. But the reality is big banks don't want to see that. They want to see you're profitable. The more profit you make, the more value you are to them. So even things like this, where it's hard to prove your income or hard to really prove the business's income, because of things we all know that we're writing so much off, it's more difficult to get money from big banks as it is then to be able to come do that with private investors. Private investors are really looking more of, does the deal make sense? They understand they're getting fallout deals that banks aren't going to lend on. They know that they're getting deals that don't meet banks' normal underwriting guidelines, And so as a result with that, they're more flexible. They understand they're dealing with a higher risk borrower. So some of these kind of financing is referred to as hard money loans. And this is a couple different ways. Yes, it is real estate in the form of what we're talking about today. There's also hard money loans with all kinds of other business funding as well, the same as there's private investors for all different kinds of business funding. So this is issued by a private lender for non-owner occupied properties oftentimes. Okay, it's usually short-term loans like 36 months, and they have higher interest rates than traditional bank loans. We sometimes refer to these as bridge loans, and there are two different things. Hard money and bridge loans are two different things, but oftentimes these are used to bridge the gap. So let me give you an example. Your credit's not good enough to get an SBA 504 loan, but you're working on fixing your credit. Well, and there's a great deal on a residential property you could buy right now and turn around and make a killer return if you're able to buy it. Well, that's a perfect example where a hard money lender can come in. They can give you the loan. It's only for 3 years. So you got to find another solution when that 3 years is up, but it lets you buy the property while you're in this example fixing your credit to qualify for the SBA 504 loan through your bank. So hard money loans are approved based on the value of the real estate rather than the creditworthiness of the borrower. Again, what we're looking for is, does the deal make sense? If we're looking at buying a property for $50,000 and we know it's worth $110,000 and $10,000 worth of repair puts it on the market, that's a common sense deal. You're buying a property for $50,000, you're going to put another $10,000 in it, you're in it for $60,000, you could sell it for $110,000, almost a 100% return on your investment. So in that example, that makes a lot of sense. And an investor is going to entertain that deal even if you have credit issues, because if you default, they could take the property and they already win because the value of the property is so much more than the actual purchase price. That's what I mean by banks versus lender investors. A bank could never look at that deal because a bank's guideline for credit score is X, 700, let's say. But an investor might say, look, we prefer to see investors with 650 credit scores. But then you roll in the door with a 620 score, buying a property that's worth $110,000 for only $50,000. And the investor is able to be flexible and still entertain the deal because the property and the equity and the value of the property is so high that it's worth the risk of lending to somebody with damaged credit. So again, the main differences with the lender is hard money banks are almost always given by that private lender. Okay, so then again, they have more ability to be able to make those on-the-fly decisions. But the caveat is that they charge higher interest rates, right? They're going to charge different kind of fees than you're exposed to at big banks. And we're going to talk about fees they're going to charge here in just a minute. So do me a favor, if you're getting value from this, just hit the like button, hit the love button. It helps me show the other social platforms that we're getting into some good content. It's the only thing I ever ask. So if you don't mind, hit that like button, hit the love button if you're getting some good value out of this today. So let's talk about this. They're going to pay higher interest rates. They're going to pay higher fees. And I was on Reddit yesterday and answered a question, and this was a question on Reddit. Do you think it's ethical for lenders to charge 35% interest rates to borrowers? And my response was this: if you don't like the risk, or interest is based on risk. If you don't like the interest, then lower the risk. It's that simple. Meaning, I love it when banks or investors charge high interest. And here's why. It means they'll work with high-risk borrowers. If you didn't have lenders that would charge higher interest, you wouldn't have higher-risk borrowers that could get help. We'd all be in a world where we all need 700 FICO scores and tax returns to show profit and tons of collateral to get money. But we don't live in that world. We live in a world where it's very easy for us to get money for our business if we have some kind of lendable strength. And the reason for that is because banks can take more risk because they have a greater rate of return because they charge you more money. So I love it that private investors make more money than banks. They should make more money than banks. They're willing to help you when big banks won't. When you have credit issues, when you have all these problems where you can't walk in and get an SBA 504 loan to buy real estate, you're still able to come in and get money from a private investor, and their return is that they're going to charge higher interest rates, they're going to charge higher fees. And we'll talk about what these fees are here in just a minute as well. So the Truth in Lending Act, TILA, basically doesn't apply to commercial mortgages, something to keep in mind, but there are still regulations traditional financial institutions must follow. Federally insured banks are still regulated by the FTC. Credit unions are regulated by the National Credit Union Administration, but hard money lenders don't have these regulations. We talked about this already, that credit unions and banks are regulated by the government. The government requires they be conservative in their risk, And it's kind of a joke to be conservative in your risk when you're lending to businesses. We are inherently risky borrowers. So it's very tough. And this is why banks are never the best source of money for us as small business owners, unless we're really well established. And it's also another reason that, again, it just makes a little bit easier for private money lenders to lend you money. Now, keep in mind the Fair Credit Reporting Act, the Truth in Lending Act. These things don't apply in the commercial world. They apply in the residential world. And also keep in mind that hard money lenders can lend on commercial or residential real estate. So there's different options here. You could use the money we're talking about today to buy and flip residential homes. You could also do multi-units. You could also do flat out commercial buildings and property as well. So hard money lender may loan on any type of non-owner occupied real estate. This includes all sorts of real estate investments, but they're also looking for solutions with a fairly quick exit strategy so they know they're going to get paid. They're looking for fix and flips. They're looking to get a greater rate of return. They'll sometimes do an owner-occupied property, but what they prefer is for if you're going to occupy the property that you have other units in the property that are also rented, okay? And I saw an example at the mastermind I was at this week where that exact same thing had happened, where they're paying $16,000 a month in rent right now for the building. They bought the building and their payment went up to like $22,000. But the building they bought came with tenants in place that were already paying $12,000. So in the end, they paid less money than they were paying renting because the property came with a renter in place that had a history of paying rent as agreed. This is what these private guys look for. They will do some owner-occupied property, but they prefer if you're buying investment properties, especially in the commercial world that already have tenants in them, or if they are in the residential world, they prefer that you have a plan to get in and out in 6 months or so they can make their money. Most hard money guys in the real estate space, they don't like long-term transactions. That's why these are 2-year, 3-year loans on the commercial side, as short as 6 months when you're getting money to flip properties. So hard money loans are very common with this fix and flip of properties. And really, there's a couple different types of properties. We can either fix it and flip it. We buy it, we fix it up, then we flip it and sell it. Or we could buy it and hold. It's called a buy and hold. We buy the property, we do any repairs, and we hold on to it and we rent it out. So these are very popular with fix and flip, where you buy the money, fix it up, and then actually turn around and sell the property. As a matter of fact, it's one of the most common kinds of financing in that industry. If the lender's also financing the repair, then they'll estimate the cost of repair and they'll issue draws. So let's talk about this as well. If you've ever gotten a construction loan, fix and flip loans work exactly the same way. So if you get a construction loan to build a house, what happens is the lender says, okay, we're going to approve this construction loan for $300,000. They don't give the builder $300,000. The builder has to complete certain phases of the project and then get money released. They lay the foundation, inspections are done, foundation is solid, here's your $50,000. They build the frame of the house, frame looks good, here's another $50,000. They put up the drywall, etc. It's inspection passed, here's another $50,000. It issues the money and draws to the actual construction company as they complete certain aspects of the actual house. Then these draws are released to them for the work they've done. Same thing with fix and flip. Fix and flip, they estimate the cost of the repairs, and then what they do is they give you the money to buy the property. Then they release the money as you've completed different phase of the project that you're working on. So you come in, the project's trashed. When you do the first thing, you do all the demo and destroy the property and tear everything out. Okay, here's your first draw. Money is released. Now you come up and you get everything done and you drywall and get everything painted. Here's the next phase of draw that gets released. So that's the way fix and flip properties work, is they release money as you complete different stages of the project. Now, many hard lenders prefer to finance the repairs. This way they know the project's going to be completed. If you think about it, they like it done this way. They're not just giving you money to go fix it. They actually have inspectors that are looking at the repairs every stage of the way to make sure that you're doing it right. And if you're not and you don't know what you're doing, well, then in that case, then they basically take the property back and they're going to be like, oh, this guy doesn't know what he's doing. So first of all, it's why for this property or for this product, they want people with flipping experience. You should have flipped 2 or 3 homes to get into it. They're going to want you to have some cash that you can put in reserves in an escrow account so they know that they have some kind of return there. They're going to want about average credit, about a 620 FICO score. If you meet those 3 requirements, you can get into fix and flip financing. But again, they want to release that money and draw so they can make sure the work is getting done as the work is supposed to get done. Now, Marlon coming in from LinkedIn and says, where can I get information for hard money lending? Well, we're going to go over with a lot of that today, right now. And if you want more information, you can get in touch with us at our number, which I'll give you at the end of this, 877-600-2487. Or you can go to creditsuite.com/get funding, fill out a handful of questions, and our funding team will be in contact with you as well. Marlon says, I have a property under contract and would like to get information regarding funding. Go to creditsuite.com/get funding or give us a call at 877-600-2487, and our funding team can get you the information you need or get you to a source that can help you with that as well, Marlon. Okay, so the goal here is to often refinance the property in 12 to 36 months. So that's the goal. So hard money lenders will also provide short-term loans for residential real estate investment. As we talked about, they're short-term loans. This isn't going to work for you to buy and hold the property. It's usually only 12 to 36 months. Fix and flip financing is typically only 6 months. This is the term that they're going to give you, okay? Investors may use a hard money for a rental property if they need to be able to close the deal quickly, and then you got to turn around and get a regular mortgage on the property is what typically happens. And this is why I call them bridge loans, because private investor money for real estate, hard money investor for real estate, it's kind of the way you can get in and quickly get a property because you know you're getting a good deal, but it's not for long-term financing. If you want long-term financing, you're going to have to refinance out of it into a conventional bank loan or longer form type of financing. Now, like money loans for rental properties, investors may need capital quickly to get multifamily properties as well. And if this is the case, well, then a lot of traditional lenders aren't going to be the best source, but private money lenders can help you here as well. An investor may also be buying a multifamily property with little to no tenants that needs a lot of repairs. This type of property would be hard to get financed with the bank because they'd want tenants in there. So you need to search out a hard money source. So there's a lot of different ways, whether you're buying residential property, commercial property, whether you're buying multifamily properties, this all works really, really well for any of those types. Now, a common situation in commercial real estate is an investor having a tenant to lease space to, but no property to put them in. The investor will find a vacant property that the tenant will then lease out, but then they have to buy the property and get it ready for the tenant. So this is a perfect example. There's a lot of these examples, but let's say they have tenants and no property. Well, then that's a perfect scenario for private investors because they already see that if they get the property, that they're going to have a rent roll, that they're going to be able to put people in there. Now, a bank wouldn't do that if the property was vacant, okay? And if the borrower doesn't have the assets to secure the loan, the collateral equivalent to the loan amount. So a hard money loan can be useful in that situation as well. A lot of these unique situations where you need to act quickly to buy commercial, residential real estate or multifamily, and you know a bank's not going to work, you can use these to bridge the gap until you get those other kind of loans. Now, the convenience and easy approval of the hard money loan comes at a cost, as I mentioned. Lenders are going to charge higher risk interest rate. And as I mentioned, it's because the risk of these is higher, and it's also the loan terms are shorter in this case as well. Okay, longer loan terms will earn interest for several years from processing on the loan, but the money invested in hard money loans must be invested every 6 to 36 months. You got to think about that. They're going to charge you more interest because they have less time to make money on you. A bank, for example, that gives you a 30-year mortgage, they have 30 years to make money on you. But in this case, if they only are getting 6 months or 36 months to make their money, they got to make all their money in interest in that 6 to 36 months. And that's why they're going to charge you higher interest. Now, what do I mean by higher interest? Fix and flip properties are typically 8%, 9% interest. I don't even think it's hard money. And that's because I think I come from the mortgage world where I've seen very expensive interest rates on properties. But again, 8 or 9% is what we're looking at with some of these higher risk private investor financing that we actually see through private investors and fix and flip. So here, so hard money fees. The lender's going to charge upfront fees to cover the cost of the processing of the loan, plus any commissions being paid. They also ensure they can still earn a profit. So here's some of the fees that you're going to be exposed to: origination fee, a broker fee, an application fee, an underwriting fee, a doc prep fee, a processing fee, funding fee. These fees can add up to thousands of dollars, sometimes tens of thousands, depending on the property size. So you really need to make sure that you know what you're doing here. So for example, we see that a lot of private investors, the lender or the funding source or the broker charges additional fees on top of the lender. Now, we don't do that at Credit Suite. If we can help you with this, we can help you find the right funding source. We don't attach our own fee on top of it, but most brokers do. Most brokers are having you sign a separate agreement saying you're going to pay them a fee as well as the lender they help actually get the money from. So keep in mind that these fees exist. Don't get caught up and then just tell you you're going to pay 8% interest and you're satisfied with that. Ask them what fees they're going to charge and understand clearly the fees that you are going to pay. because sometimes the fees can be considerably more than the actual overall payment you'll pay on the interest, especially on 6 to 36-month loan terms. Okay, so in general, private lenders are going to be all right with average credit. Their main concern is the value of the property, as I mentioned. So again, even if you have damaged credit, private investors are the way to go. You could not go to the bank. Banks are not going to help you if you have credit issues and you're trying to get into any kind of real estate transaction. Okay, now in a lot of cases, there's balloon loans at the end, and that's what it means. And let me explain how that plays out. A lender will give you a 30-year amortization. So what it means, they'll base your monthly payments on the fact that you're paying them back in 30 years. But you really have to pay them back in 3 years. So they say, okay, over 30 years, your payment's $500 a month. You're going to pay $500 a month. But at the end of that 36 months, that 3 years, the money's going to balloon and you're going to have to pay us off. So that allows you to still have low payments because they amortize the payment over 30 years, give you your payments are calculated as if you were paying back over 30 years. But then the reality is you need to actually in 3 years pay a balloon, which means you need to refinance out of it and get into another kind of financing. For fix and flip, the lender knows the borrower can afford the balloon payment because you're flipping the property, right? They know that you're going to flip it in 6 months, so that's why they're comfortable with it. But in the case of a borrower looking to refinance the property by the end term, they may not be as willing to lend to somebody with bad credit. So again, longer term financing for real estate is harder to get, which is why these private investors really are doing short term while you fix your issues to get into longer term financing. So lenders who will look into a borrower's experience, okay, for fix and flip, they want to see that you've completed at least 2 or 3 projects, which we talked about. Smaller lenders usually stick to markets they know in states they have a strong real estate market. They really prefer with fix and flip to be working with investors that have actually flipped properties before. So when we talk about this, there's a lot of options. There's fix and flip private financing. There's hard money loans. You could buy, you could refinance, whether it be commercial properties, multifamily, or individual units. You can even own a bunch of properties and put them into one blanket loan from private investors where they'll give you money and then use all of your properties as collateral into one loan. It's an option we didn't talk about, but an option that could very well work for you. And if you want information on getting funding, then feel free to give us a ring, okay? Because this is what we do. We work with over 1,000 funding sources, private investors, lenders, credit or lenders, fintech lenders, online lenders, conventional banks, and we can find the best funding that works for you and get you to that funding source. Marlon just said, hey, I'm working on a deal. How do I do it? I'm like, get with our funding team. When they get with our funding team, our funding team will say, oh, Marlon, I know exactly where to go. Here's an investor that works. We're going to send your information to them right now. So we work with these investors and lenders, and we never charge you fees. It's free, $0 for us to help you. And the reason for that is some of the lenders give us a referral fee. Some don't, okay? This isn't where we make our money at Credit Suite. We offer business credit and funding, or business credit and fundability solutions. But so many people come to us for money that we help with finance, and we just don't charge for that. The lenders pay us a referral fee, and we'll help you actually graduate all the way to the best loans, your SBA loans, et cetera. So you get access to all funding in one place. If we can help you with that, let us know. If you got value from this, hit the like button, hit the love button, and follow us on our other social channels. We go live on Facebook, YouTube, Periscope, as well as LinkedIn, Tuesday and Thursday at 11 o'clock on Wednesday. And then we have daily tips on Instagram, Twitter. We have a podcast you can listen on the go. You can access all that stuff at the top right of our page. And all I ask is, if you got value from this, hit the like button, hit the love button, subscribe. And then if you subscribe on YouTube, click the little bell and click all, and it will select you whenever we actually release new content. And somebody from Joshua, you should join this group. Lots of helpful information. We do have a great Facebook group called Get Business Credit. Over 35,000 people in our group, over 45,000 engagements, likes, comments, posts every 28 days. So a very active group. Feel free to join us there. Lone Wolf, I love it. Since I got your call, the 7 factors are that I only have less than 800 to work with, and no one will approve me on that. And even you can get in touch with us on that, Lone Wolf. It sounds like you need a specific, you need to know how to get money based on your specific scenario. Give us a ring, 877-600-2487. If you're not really a phone guy, you're more of an introvert like I am, then email info@creditsuite.com. Give us your individual scenario, and we can talk through that with you. And Taranya says, Ty, can you help the rehab into the loan? We can't help you with that as well. Meaning if you're going from a fix and flip that you've had for 6 months and you need to go to longer term financing, we can definitely have a conversation with you. We work with a lot of long-term conventional lenders as well. And Juby, no, thank you. And Jeff says, good comment. I look forward to offering this value into the Latino small business community. Exciting. And just so you know, our finance suite, if you join with us as a partner, our marketing materials and our system itself can be switched from English to Spanish. Our marketing materials are all available in English and Spanish, so you can offer business credit financing in Spanish. And then our finance suite, at one click at the bottom, our videos, all the content changes from English to Spanish. So that's something that can help you as well. If you're interested in offering business credit financing for your customers, whether it be in English or in Spanish, give us a ring and we'll give you a demo, 877-600-2487. I'm going to wrap up. Thank you all. I'll be talking to you next week live as we dive into more cool ways to get money for your business. Thanks, everybody.